Staying on the topic of money, now that the Federal Reserve has begun raising interest rates, how will it impact you and your wallet? Here with answers and practical tips is financial expert and author of Good Money Revolution, Derek Kinney. Derek, thank you so much for joining us.
My pleasure, Matt. Great to see you.
Well, let's just first talk about that stock market real quick and what impact will investors see there with interest rates going up?
Well, we know the market doesn't like uncertainty. It likes to know what the plan is. The problem is that it rarely happens. Think about Ukraine, think about interest rates, rising inflation. All of those cause a lot of volatility. What we saw earlier in the week, though, is really telling, though, Matt, and that is when the Federal Reserve Chairman talked about inflation is the #1 enemy of the Fed, the market loved it because they saw somebody take an aggressive, proactive action, because what we know is inflation causes consumers to lose confidence, and that means the economy doesn't grow.
So basic question here, what about checkings and savings accounts? Will consumers see an increase on their money if they have it parked in a bank?
Well, most people may be earning 1/10 of 1% in checking. It's not that get rich quick account by any means. They're not going to see much gain in checking or savings. Where they might see a bounce, though, as rates gradually go up. We expect about 5, maybe 7 rate increases this year. They may see CDs, those certificates of deposit, that may be worth about 0.25% right now. Those will gradually go up. So for a longer term investor, maybe you're retired, you may see some benefit there.
All right, so let's talk about credit cards, loans. People are trying to get into the housing market right now. What can we expect to see along those lines? Those are pretty common around here.
Yes, they are. And one of the big variables there are variable rate credit cards and loans. For example, if you have a credit card, these are more rare, Matt, but if someone has a credit card that resets itself every year, you're going to be paying a higher interest rate when that resets. But think about students right now that may have variable rate student debt. You may want to look at refinancing that as quickly as possible to lock in the lower rate. Same for all of our viewers that may have an interest rate on their house of about 4% or higher. Talk to your mortgage broker right now to see if refinancing may save you money and lock in a rate and possibly help shave off some years off that note.
And so with interest rates also being so high right now, to get a loan for a first-time home buyer, what would you tell them, whether they're wanting to refinance or if they're wanting to even buy right now? Is it a time to just say, hey, let's pump the brakes?
For many people, pumping the brakes may be the best course of action. The problem is, will rates come down in the near future? Probably not. And will home values drop anytime soon? Probably not. And so if you're waiting to buy a house, you may want to actually look at going ahead and buying the house. Even if interest rates go higher, you can always refinance down the road. It's always better to get the house you want, pay a higher interest rate, and then refinance it later on. But if you are feeling worried, anxious, nervous, waiting it out may take a couple years, but you might get some deals if you shop around and can find some distressed properties.
All right, great tips there from Derek Kinney, financial expert and author of Good Money Revolution. Thank you so much, Derek, for being with us.